10-year note yields hold the 3 to 3.25 range, the range that we've had set since we ascended through 3% earlier this year. And it just seems the market, while it haven't had many attempts to break below 3% or above 3.25 like we've seen those marks, it seems to me now that we're seeing some momentum pushing us. And we've talked about this, the race to 3%, the race to 3% stalled, and now we're back on for the race to 3%. Ultimately, it becomes really a bigger picture than what we're looking at technically. Yes, we've seen buyers come in and the market's held, but it hasn't been able to bust through. And yet the leverage funds, while have been exiting, some of those shorts remain uber short, we'll call it. And that will be the swing point. I think if we bust through 3%, we see a 2 handle on the yield, it's likely going to trigger a lot of buying, and that could push us yields even lower, kind of exaggeratedly so. But we are holding that range after Powell today, after the data we've seen this week, and ahead of FOMC minutes. So nothing yet has changed. And market volatility, as you can expect, which has been elevated, is now no longer elevated, it is lower. So the market taking a sigh of relief. Not only did we hold the range, we got through Chairman Powell speaking, we got through some data, we got through the auctions this week, and the market really hasn't seen a major move either way. Knee-jerk reaction or the other expectations have been met, and that is typically the definition of when we talk about lower volatility, when we're meeting expectations, not breaking out of them, something we haven't done in a while. And lastly, let's look at Powell. What did Mr. Powell say today that excited the stock markets, that revved up the bond markets and took volatility to new lows? Well, ultimately, I think he left the door open for, yes, a rate hike in December. Yes, further rate hikes down the road. Yes, possibly hitting that neutral level, as he called it. We're very close, which means that would also mean a pause. So he gave the market, fed the market sort of what it wanted. And I think at this point, the market right now wants clarity from the Fed, and they got that from Clarita yesterday. They got it from Powell today, that the Fed remains ready to stand and act or do nothing, or both. And I think that right now the stock market, the uncertainty from the Fed suggests they are likely going to err on the side of caution, and that means holding rates lower or raising them slower, I guess is the best way to put it. They're going to continue to raise rates, just maybe at a slower pace in 2019. And if you look at the Fed Fund futures, they're telling you that already, whereas the Fed dots were telling you that maybe we're going to be a little more aggressive. And we may see at the December FOMC later next month that pullback in the dots. Perhaps you're going to see a sub 3% 2019 expectation. Likewise, you'll see a lower expectation for 2020. So right now, I think Powell fed the markets exactly what it wanted, and we saw it to eat it and take the bait, hook, line, and sinker. Equities rallied. Treasuries initially rallied, but then went right back into the range and sort of traded unchanged. So you're still near that 3% yield, but not able to push through it. And I think that's going to be the case for the time being, at least until we get to that December FOMC, when we get a press conference and we get new dots and new forward guidance. That will be the next moment, not only for the bond market, but I think also for the equity market. So right now, holding steady. The range did not get exceeded today, not that we anticipated it would. Volatility down, all after Chairman Powell spoke. And the next time we see him speak, well, things could be a little bit different.